DeFi isn't dead, it's evolving. The early era of decentralized finance was defined by hype, sky-high APYs, and reckless optimism. Protocols were promising 1,000% returns, and investors were flooding in without asking a simple question. Where is this yield actually coming from? But now the landscape is changing. The next generation of DeFi isn't about minting tokens out of thin air. It's about real yield. These are projects that generate sustainable income from genuine on-chain activity, trading fees, lending spreads, validator rewards, and share that revenue directly with users. This marks a shift from speculation to sustainability. The new wave of DeFi protocols is designed for long-term investors who care about consistency, transparency, and economic logic. Instead of chasing temporary token emissions, smart investors are focusing on ecosystems like GMX, Lido, and Synthetics, which reward participants with real, organic returns tied to protocol performance. This is DeFi maturing, moving from flashy incentives to actual business models. In the early days of DeFi, during the 2020 DeFi summer, yield farming exploded. Projects offered astronomical returns, 500%, 1,000%, even 10,000% APYs. But almost all of it was fake yield. These rewards weren't generated from real activity or profits. They came from minting and distributing new tokens to lure in liquidity. The system depended on new participants constantly entering the market. Once the inflow stopped, token emissions overwhelmed demand, prices collapsed, and the so-called passive income evaporated. For example, Iron Finance, once boasting over $1 billion in TVL, collapsed overnight when its algorithmic token lost its peg, wiping out investors in hours. Similarly, Tomb Finance and countless high-yield farm and dump protocols offered massive short-term rewards that quickly vanished once emissions outpaced real usage. The hard truth became clear: yield without cash flow is just disguised dilution. Today, the DeFi market has matured. The conversation has shifted from unsustainable token printing to revenue-backed yield models. Projects now aim to generate and distribute income from actual economic activity, like trading fees on GMX, validator rewards from Lido, or synthetic trading revenue from Synthetics. This shift signals the industry's evolution towards stability and professionalism. The key lesson? Sustainable yield in crypto doesn't come from emissions. It comes from economic utility. Real yield is built on usage, not speculation, on fees, not fantasies. It's not about chasing hype. It's about owning a piece of the real on-chain economy. The idea of real yield is deceptively simple. It's DeFi's version of traditional dividends. Instead of paying users with freshly printed tokens, these protocols reward participants with revenue generated from real economic activity. That could mean trading fees, lending interest, liquidation penalties, or validator rewards. The returns are backed by cash flow, not inflation. This concept marks a major turning point for DeFi. During the yield farming era, protocols relied on token emissions to attract liquidity, a model similar to a startup giving away equity just to keep users. Real yield projects flip that logic by aligning user rewards with actual usage. When the protocol grows and generates more fees, the community earns more. When activity slows, yields adjust naturally, creating a system that's self-sustaining rather than self-destructive. One of the clearest examples is GMX, the decentralized perpetual exchange on Arbitrum and Avalanche. Instead of paying users in GMX tokens, it distributes 30% of trading fees directly to stakers, in ETH or AVAX. That means your income is tied to actual market volume, not token emissions. In volatile markets, when traders flood in, yields rise, and when activity cools, rewards normalize. It's a natural feedback loop that keeps the system balanced. Another case is Synthetics, SNX, one of DeFi's earliest real yield pioneers. SNX stakers receive a portion of trading fees from synthetic asset transactions. Real revenue earned from users trading synthetic versions of assets like ETH, BTC, and commodities. DYDX in its V4 model is also adopting a similar approach. distributing trading fees to validators and stakers based on actual usage. The essence of real yield is transparency and sustainability. You're not depending on hype or inflation to get paid. You're earning from the genuine productivity of the network. And that's why more sophisticated investors are shifting their capital toward real yield protocols, because real activity equals real income. One of the biggest catalysts behind DeFi's next phase of passive income is the explosion of liquid staking derivatives, or LSDs. These instruments have revolutionized how investors earn yield on staked assets, particularly Ethereum after its transition to proof of stake. Traditionally, staking meant locking your ETH for months with no flexibility or liquidity. LSDs changed that by allowing you to stake and still use your capital in DeFi. Here's how it works. When you stake ETH through a protocol like Lido, you receive stETH, a liquid representation of your staked ETH. You continue to earn staking rewards, but because stETH is tradable, you can use it across DeFi platforms to borrow, lend, or provide liquidity. Essentially, you're earning yield on top of yield, compounding returns from multiple layers of activity. This innovation unlocked enormous capital efficiency. For instance, a user could stake ETH with Lido, receive stETH, deposit it on Aave as collateral, and then borrow stablecoins to farm further yields. The same ETH is now generating multiple streams of passive income. That's the magic of LSDs. They make capital work harder without compromising security. The growth has been staggering. By 2024, over 30% of all staked ETH flowed through LSD protocols like Lido, Rocket Pool, and Frax Ether. Lido alone holds tens of billions in staked assets, paying users real validator rewards in ETH, not inflationary tokens. New entrants like Eigenlayer are pushing this concept even further with restaking, allowing stakers to earn additional yield by securing multiple networks simultaneously. LSDs represent the bridge between DeFi and staking infrastructure, turning long-term capital commitments into flexible, income-generating assets. They've become the backbone of modern DeFi yield strategies because they blend security, liquidity, and sustainability. In many ways, LSDs are the purest form of real yield, returns generated from core network operations, distributed directly to users without hype or emissions. The takeaway? LSDs aren't just a new product. They're a paradigm shift. They've transformed staking from a passive, locked process into a dynamic engine of yield generation, powering the next wave of sustainable DeFi income. As DeFi matures, protocols are starting to look more like real businesses, with revenue streams, profit-sharing mechanisms, and self-sustaining liquidity systems. This evolution is clearest in revenue-sharing and protocol-owned liquidity (POL) models, which are reshaping how investors earn from DeFi. In a revenue-sharing model, token holders or stakers earn a direct share of the platform's profits, not through token emissions, but through real on-chain cash flow. For example, Curve Finance's Vecurvy system rewards long-term token lockers with a share of trading fees collected across its pools. Similarly, Balancer distributes trading revenue to VEBAL holders, while Frax Finance channels income from its stablecoin operations, LSD yields, and lending markets into buybacks and distributions for holders. These aren't speculative returns. They're dividends from protocol usage. Another pioneer is Redacted Cartel, which earns yield from managing and optimizing liquidity across DeFi protocols. It reinvests those earnings into its treasury and shares value with token holders, essentially functioning like a decentralized yield fund. This is part of a broader shift toward DeFi 2.0, where yield isn't rented from users, but owned by the protocol itself. That's where protocol-owned liquidity comes in. Instead of bribing users with high APYs to provide liquidity, which often leaves once rewards dry up, protocols now own their own liquidity pools. They accumulate LP tokens through bonding, treasury swaps, or emissions optimization. This means they control the liquidity that underpins their tokens, keeping it stable and reducing dependency on mercenary yield farmers. Olympus.io popularized this model, and many DeFi projects have adopted similar mechanisms to ensure long-term liquidity depth. These systems are far more resilient. When a protocol earns real revenue and controls its liquidity, It doesn't have to rely on unsustainable incentives. Token holders benefit from a steady, transparent flow of income tied to the protocol's actual performance, just like shareholders in traditional finance. In essence, revenue sharing and POL models mark DeFi's transition from experimental to institutional grade. They replace inflation-driven farming with profit-driven participation, giving investors exposure to genuine recurring revenue rather than temporary hype. It's a fundamental evolution, from chasing yield to owning the engine that generates it. To identify truly sustainable DeFi income, start by asking, where does the yield come from? Real yield should come from actual on-chain activity, trading fees, lending interest, or validator rewards, not constant token emissions. If a protocol needs new users to sustain payouts, it's not yield, it's dilution. Next, look at what asset rewards are paid in. Strong projects like GMX or Lido pay in ETH, BTC, or stablecoins, not in volatile governance tokens. That ensures rewards hold real value. Transparency is key. Check data on DeFi Llama or Token Terminal to verify if a protocol generates real revenue that matches or exceeds its payouts. GMX, for example, openly shares millions in weekly ETH fees with stakers. That's verifiable real yield. Finally, observe TVL trends. Stable or growing TVL without inflated reward signals lasting confidence. When liquidity sticks around even after incentives drop, it means users trust the system's fundamentals. In short, sustainable DeFi yield is earned, not printed, powered by genuine economic activity, paid in real assets, and proven by transparent on-chain data. That was all from us today for this video, folks. For more similar content, make sure to subscribe to the channel. See you in the next one. See you in the next